Hi, Professor Barati here. I'd like to go over some audit features concerning acquisition cycle and inventory. I think inventory is probably one of the misunderstood assets on the balance sheet, and auditors tend to spend a lot of time on inventory valuation. Outside of accounts receivable, inventory is a very important asset. Obviously, if the inventory is wrong, the cost of goods sold on the income statement will be wrong, and therefore the profits reported will be wrong. So there's a cycle here, as well as the purchasing through accounts payable, purchasing of inventory, and the use of inventory to generate cost of goods sold and sales. So I just want to go through a few slides to emphasize some of the important auditing features when it comes to inventory and the acquisition cycle. So what is the acquisition cycle? It covers the purchase, receipt, payment, and accounting for goods and services, which may include other things other than inventory, such as office supplies and so on. But the major accounts that is emphasized here are the inventory, accounts payable, and related expenses. The main phases in acquiring and payment process is going to be how the authorized requisition is handled, authorized purchases, how we receive goods and services into our accounting system, the approval process for payment, and the cash disbursement. The risk and business analysis acquisition cycle deals with the receipt of all goods and services. Misstatements may occur just because of the volume of transactions. It is also an area where fraud is likely to take place, such as employee theft of inventory, employees setting up fictitious vendors and paying themselves for goods never received, executives abusing travel and entertainment, capitalizing expenses as assets to inflate earnings, which we learned about in our WorldCom case, overestimating restructuring reserves at the time of acquisition so expenses could be reduced in future periods. The red flags of the acquisition and payment cycle could be inventory growing at a rate greater than sales, which would be an indication that something's wrong, that the inventory is becoming obsolete, not being used, and not being written off properly, which is not fraud, it's just bad accounting. Expenses significantly above or below industry norms. Capital assets growing faster than the business, which means the company may be misclassifying expenses as capital assets. A reduction of reserves, which that means such as the bad debt reserve and so on. If you see reductions in reserves, that could mean that the company might be overstating profits as well. Expense accounts that have significant credit entries, travel and entertainment that do not have documentation, inadequate follow-up to auditor recommendations on needed controls. This slide discusses the analytics that can be done as far as misstatements. The procedures to identify potential misstatements: calculate and analyze dollar and percentage change in inventory, cost of goods sold, and expense accounts. Compute and analyze ratios like inventory turnover and number of days sales in inventory. Prepare common size income statements to identify cost of goods sold or expense accounts that are out of line. A common size income statement is simply an income statement that's converted to percent of sales. So if cost of goods sold is historically a 33% or 40% line item on the income statement, and all of a sudden this year that you're doing the auditing, it has declined to say 20%, therefore a huge gross profit is appearing on the income statement. It needs to be identified. Auditors compare client analytics to past client performance, industry results, and expectations. Overview of control procedure and control risk assessment. Requisition goods or services need to be identified. Pre-numbered requisitions from completed and sent to purchasing. Purchase goods or services. Purchase order shows quantity, price of goods ordered, quality specifications, shipping terms. Purchase orders are pre-numbered to establish completeness. You want to see them in sequential order as well. Purchase orders must be properly authorized. You need to see signatures. Many companies have separate purchasing department. Agent's job is to find combination of price, service, and quality. This reduces fraud, centralizes control in one location, and control set to stop purchasing agents from abusing their position. Receiving goods. The receiving department should ensure only authorized goods are received. The goods meet order specs. An accurate account of goods received is taken. All receipts of goods are recorded. Receiving department records quantity of goods received at the correct price. Goods also inspected for quality. Receiving reports are sent to accounting. The risk and control for payment. Accounting matches vendor invoice, purchase order, and receiving reports. If quantity and quantity match, accounts payable is then recorded. Cash disbursement should have supporting documentation that is reviewed and approved for payment. Documents are marked paid to avoid duplicate payment. Testing controls over accounts payable and related expenses. Controls should be related to the following. Proper authorization is required, completeness of recording, timeliness of recording, and correctness of valuation. What are some of the substantive tests of accounts payable? The auditor's main concern is that accounts payable will be understated. If accounts payable is understated, that means the expense side is also understated. Typical substantive tests include reconcile vendor statements to confirm the accounts payable balance, tests of subsequent disbursements, analytical review of related accounts. Reconcile vendor statements to confirm your payable balance. Auditors request vendors' monthly statements and send confirmation to major vendors. Auditor samples cash disbursements at the end of the year, determines if disbursements are for audit year transactions. If disbursement is for audit year transaction, auditor reprocesses the transaction to see if it was properly recorded as a payable. Analytical review of expense accounts are used to determine if accounting data indicates understatement of expenses. If understatement is likely, then expand the testing. Analytics used on clients with low control risks. Auditing payables and cash disbursements provide indirect evidence about expense accounts. Additional analysis of selected expense accounts is usually merited. The auditor should consider management is more likely to understate rather than overstate expenses, classify expenses as assets rather than expenses. Substantive audit procedures will include detailed tests of transactions, analytical review, and review of unusual journal entries. Auditing of inventory and cost of goods sold. Audit of inventory is complicated. A lot of parts, a lot of diversity, a lot of counting, high volume of activity, various sometimes complex valuations, difficulty in identifying obsolete or defective inventory, easily transportable, making it subject to double counting, may be stored at multiple locations, may be returned by customers. Internal controls for inventory. A well-designed inventory control system should ensure all purchases are authorized. A counting system ensures timely, accurate, and complete recording. The receipt of inventory properly accounted for. The inventory tested for quality. Cost properly identified and assigned to products. Customer returns of inventory are examined for defects. Inventory should be reviewed for obsolescence. New products introduced only after market studies and quality control tests have been made. Management actively manages inventory. Long-term contracts are closely monitored. Also, you might want to look for cycle counts that are being done periodically, which is a sign that the company is constantly reviewing and counting its inventory. Part of the substantive test is observe a year-end physical inventory, cut-off tests, review long-term contracts, valuation is direct tests and analytics, and review the gap. Observing a client's physical inventory, meet with client to discuss their plan to count inventory, review client's plans for counting and tagging inventory, review inventory counting procedures with audit personnel, determine whether specialists are needed. Upon arriving at each site, meet with the client, obtain a map and schedule of inventory count area, and so on. Observe the counting of inventory and note the following. The first and last tag numbers in each section. Account for all tag numbers to prevent later insertion of additional inventory items. Select test counts, items that appear obsolete or defective, high dollar value items in inventory, movement of inventory during the counting process. Once the inventory count is done, the auditor should trace the test counts to the client's inventory records, trace the number of high-dollar items to the client's inventory, and trace the obsolete or damaged inventory to the client's inventory to be written down. On occasion, it may not be feasible to count inventory at year-end. Acceptable to count inventory before or after year-end if controls are strong, the opportunity and motivation to misstate inventory is very low. The auditor can test year-end balance using analytics. Auditor reviews intervening transactions for unusual activity. Inventory cutoff tests obtain information on last items shipped and received at year-end. Compare this information to transactions recorded in the sales and purchase journals. Auditors should also inquire about any inventory out on consignment, tracing test accounts, and number of high-dollar items on the client's inventory records test completeness. In most situations, expected returns of inventory are not material. However, some companies provide return guarantees and expect significant returns. Inventory valuation is the most complex assertion because of the volume of transaction, diversity of products, variety of costing methods, difficulty in estimating net realizable value of products. Auditor uses direct tests and analytics to assess inventory valuation. Direct tests will include verifying cost by reviewing vendor invoices. Auditor usually examines current market data and other conditions. Management inquiry and review of industry publications can help the auditor identify obsolete units. Analytics like inventory turnover or days sales in inventory might identify slow-moving inventory. Auditors look for obsolete units during the counting of inventory. These units may need to be written down. Lastly is the appropriate disclosure process. Auditor reviews client disclosure in compliance with GAAP. The disclosure should include costing methods, frequency of accounting, inventory pledges, collateral, any other unusual circumstances. The audit of cost of goods sold can be direct tied to the audit of inventory. If beginning and ending inventories have been verified and acquisitions have been tested, cost of goods sold can be directly calculated. Thank you for watching the video.